There's a moment every retiree eventually faces. Maybe it comes in the quiet of a Monday morning, coffee in hand, when you realize you don't have anywhere to be. Or maybe it hits you the night before your last day of work, lying awake with a peculiar mix of joy and terror swirling in your chest. The paycheck, that reliable, faithful, every 2 weeks visitor to your bank account, is about to stop showing up. And that changes everything. I've spent a long time thinking and writing about retirement. What makes it work? What makes it fall apart? What separates the people who thrive from the people who spend their golden years quietly anxious about money? And if there's one thing I keep coming back to, one thing that doesn't get nearly enough attention in the popular conversation about retirement, it's this. It's not just how much you've saved that determines your security, it's how you draw it down. The order in which you tap your accounts, your taxable brokerage, your 401k, your Roth IRA, can mean the difference between a retirement that feels abundant and one that feels like a slow financial unraveling. We're not talking about small differences here. Done right, a smart withdrawal strategy can add hundreds of thousands of dollars to the lifetime value of your portfolio. Done wrong, you could hand a significant and entirely unnecessary chunk of your savings over to the IRS. Let's talk about how to get this right, the paycheck problem. When you're working, your financial life has a beautiful simplicity to it, even when it doesn't feel that way. Money comes in, bills go out, you save what's left or try to. The paycheck is the engine that makes everything run. Retirement breaks that engine, and now it's your job to build a new one. For some people, that new engine will include a pension, a true rarity these days, but a wonderful thing when you have it. For most people, Social Security will play an anchor role, providing a guaranteed monthly benefit for life. Some retirees have rental income, or part-time consulting work, or annuity payments. These are your fixed income sources, and they're the foundation you build everything else on. Here's what I always encourage people to do first, before they make any decisions about which account to draw from. Sit down and really understand what your guaranteed income looks like. What comes in from Social Security, from a pension, from any other reliable source. Add it up, then compare it to what you actually plan to spend in retirement. That difference, the gap between your guaranteed income and your spending needs, is what your portfolio needs to fill. It's the number that should be driving every conversation about withdrawal strategy. Let me give you a concrete example to make this real. Suppose you plan to spend $10,000 a month in retirement. After running the numbers, you determine that Social Security will bring in $4,000 a month. That covers 40% of your expenses. The remaining 60%, $6,000 a month, or $72,000 a year, needs to come from somewhere else. That's your gap. Now, a few important nuances here. If you plan to retire early, say at 60 or 62, and you're going to delay claiming Social Security to boost your benefit, that gap becomes temporarily much larger. In the years before your Social Security kicks in, you might need to pull the entire $10,000 a month from your portfolio. That's $120,000 a year coming out of your accounts, with no government check to offset it. A lot of people hear that and feel a spike of anxiety, and I understand that. But here's what I want you to hold on to. Those early retirement years, before Social Security begins, aren't just a vulnerability, they're an opportunity. With little to no other income coming in, you may be able to manage your withdrawals in a way that keeps your taxable income remarkably low, which opens the door to some powerful tax strategies we'll get into shortly. The point is, know your gap, quantify it, then we can talk about filling it strategically. Understanding your accounts and why the tax treatment matters. So much to build a smart withdrawal strategy, you need to understand what kinds of retirement accounts you actually have. Most people heading into retirement hold assets across 3 distinct buckets, and each one has a fundamentally different relationship with the IRS. The taxable account. This is your standard brokerage account, the one where you invested money that you'd already paid income tax on. When you buy shares of a stock or an ETF in this account and they grow in value, that growth is subject to capital gains tax when you sell. If you've held the investment for more than a year, you'll owe long-term capital gains tax on your profit, which is taxed at favorable rates. 0%, 15%, or 20% depending on your income. There are two things about taxable accounts that deserve special attention. First, the long-term capital gains rates are genuinely quite favorable compared to ordinary income tax rates. Second, and this is a big one for people thinking about their heirs, assets inside a taxable account receive what's called a step-up in basis when they pass to your beneficiaries. That means your heirs can potentially inherit appreciated assets completely tax-free. This makes the taxable account, counterintuitively, one of the more inheritance-friendly places to hold wealth. The tax-deferred account. This is your traditional 401k or traditional IRA, almost certainly the largest bucket for most people approaching retirement today. You received a tax deduction when the money went in. It grew tax-deferred for decades. And now, here's the part people sometimes forget or underestimate. Every single dollar you pull out of this account gets taxed as ordinary income. Not as long-term capital gains, not at favorable rates, as ordinary income, just like a paycheck from an employer. That has major implications. If you pull $100,000 from your traditional IRA in a single year, that $100,000 gets stacked on top of whatever other income you have and taxed at your marginal rate. And when this money passes to your heirs, they pay income tax on it too. There's no step up in basis here. This is why I want people to approach their tax-deferred accounts with tremendous intentionality. They're not just savings, they're a pending tax bill. The question is whether you control when and how that bill comes due, or whether the IRS eventually forces your hand, the tax-free account, tax-free. This is your Roth IRA or Roth 401k. The money that went in was after tax, no deduction up front. But from that moment forward, it grows completely tax-free. When you withdraw it in retirement, you owe nothing, not a penny. The entire accumulated value, principal, decades of investment growth, all of it, comes out clean. For estate planning purposes, Roth accounts are also exceptional. Money inside a Roth passes to your heirs tax-free, making them one of the most valuable assets you can pass on. Here's the central tension you need to hold in your mind as we talk about withdrawal strategy. Each of these accounts has a different tax cost to access, and you are essentially choosing, with every withdrawal, how much tax you want to pay and when. That choice, compounded over a 20 or 30-year retirement, adds up to an enormous sum. The optimal order and why it works. Let me walk you through a real family to show you what this looks like in practice. Meet Phil and Claire. Phil is 62 and Claire is 55, and they're ready to retire. They've been diligent savers their whole lives. Their assets look like this: about $50,000 in cash, $500,000 in a taxable brokerage account with a cost basis of $250,000, meaning they have $250,000 in unrealized capital gains, $400,000 in Phil's 401k, $100,000 in Phil's Roth IRA, and $300,000 in Claire's 401k. All told, about $1.4 million in investable assets. They've run the numbers and determined that Phil should wait until 70 to claim Social Security, maximizing his benefit, which will be $3,200 a month at full retirement age, even more at 70. Claire should wait until 67. So for the first several years of retirement, their income gap is substantial. Now here's where the strategy comes in. What most people do, they pull roughly equally from all their accounts. A little from taxable, a little from the 401k, a little from the Roth. It feels balanced, intuitive. It's also, in most cases, leaving serious money on the table. What the analysis shows: if Phil and Claire instead draw from their accounts in a thoughtful sequence, taxable first, then tax-deferred, then tax-free, their portfolio ends up nearly $500,000 larger over the course of their retirement, after accounting for all taxes owed, including taxes their heirs would pay on inherited accounts. $500,000, not from earning more, not from taking more risk, just from being smart about which account you tap first. So what does that sequence look like, and why does it work? Step 1, start with your taxable account. In Phil and Claire's case, they're pulling roughly $100,000 a year from their taxable account during those early retirement years before Social Security begins. And here's the remarkable part. They're paying essentially zero in federal income tax on those withdrawals. How? Because when you're married filing jointly and you have no other significant income, you can realize a substantial amount of long-term capital gains at the 0% federal rate. In recent years, that threshold has been roughly $90,000 to $100,000 for married couples, meaning you can sell appreciated investments and pocket the gains without owing the IRS anything. Think about what that means for Phil and Claire. They have $250,000 in unrealized gains in their taxable account. Under the right circumstances, they can harvest those gains, sell those appreciated shares without any federal tax liability. They're essentially erasing a future tax burden while paying nothing today. Now, I want to be very clear. Please don't read this and immediately start liquidating your portfolio based on what someone on the internet told you. Tax situations are complicated, vary by state, and depend on your full financial picture. This is a conversation to have with a qualified financial advisor or tax professional who knows your specific circumstances. But the general principle that early retirement can be an ideal time to realize capital gains at favorable rates is a legitimate and powerful planning strategy. The taxable account also makes sense to use first from a pure growth perspective. The assets in your Roth, if you leave them untouched, continue compounding tax-free. Every year you don't touch that Roth is another year of tax-free growth. So you want to use other resources first and let the Roth keep doing its quiet, beautiful, tax-free work in the background. Step 2, move to your tax-deferred accounts. Once the taxable account is largely exhausted, or once Social Security kicks in and starts covering more of their expenses, Phil and Claire will shift to drawing from their 401ks. At this point, Social Security income is flowing in, which means their taxable income is higher, and the 0% capital gains window has closed. Now they're paying ordinary income tax on their 401k withdrawals. And you'll see something interesting happen here. As they draw more and more from these accounts each year, their tax rate creeps upward. This is one of the most important dynamics in retirement tax planning, and it's why being strategic matters so much from the very beginning. It's also where two other issues emerge that can quietly erode a retirement plan: taxation of Social Security benefits and Medicare premium surcharges. Most people are surprised to learn that their Social Security benefits can be taxed. Up to 85% of your benefit can be included in your taxable income, depending on your combined income. And what drives combined income? Your withdrawals from tax-deferred accounts, among other things. So when you're pulling heavily from your 401k or traditional IRA, you're not just paying tax on those withdrawals, you may be causing more of your Social Security to be taxed as well. It's a compounding tax burden that can sneak up on people. Similarly, Medicare premiums aren't flat. They increase at certain income thresholds through a mechanism called IRMAA, Income-Related Monthly Adjustment Amount. If your income in a given year crosses certain levels, your Medicare Part B and Part D premiums jump, sometimes significantly. This is another reason why managing your income thoughtfully through retirement, not just in the early years but throughout, matters so much. Step 3. Preserve your Roth for last. The Roth IRA is the crown jewel of your retirement portfolio, and you want to protect it for as long as possible. I know that might feel counterintuitive. Roth withdrawals are tax-free, so tapping the Roth feels great in the moment, no tax bill, no stress. But the reason to leave it alone isn't about the withdrawal experience. It's about what happens while you're not withdrawing. Money inside a Roth IRA grows tax-free. There are no required minimum distributions during your lifetime, unlike traditional IRAs and 401ks, which force you to begin withdrawing at a certain age regardless of whether you need the money. Every additional year you leave that money untouched is another year of compounding that you'll never owe a dime on. When you finally do need to draw on the Roth, perhaps in your 80s or perhaps never, leaving it to your heirs, it comes out completely clean. Your children or grandchildren inherit it tax-free. subject to some rules about distribution timing. There is no better asset to pass on, so save it for last, let it grow. Use your other resources first. The elephant in the room, required minimum distributions. There is a ticking clock inside every traditional IRA and 401k, and it's called the required minimum distribution, the RMD. At a certain age, currently 73 under recent legislation, the IRS requires you to begin withdrawing a minimum amount from your tax-deferred accounts each year, whether you need the money or not. The formula is based on your account balance and your life expectancy, and the required amounts grow over time. For people who have accumulated significant balances in their traditional accounts, and many diligent savers have, RMDs can force large taxable withdrawals at exactly the wrong time. Your income jumps, your tax bracket rises, more of your Social Security gets taxed, your Medicare premiums may increase. It can feel like a financial whirlpool that's hard to escape. This is why, in an ideal world, you don't just manage your withdrawal sequence, you also actively manage the size of your tax-deferred accounts throughout retirement. The strategy for doing that is called a Roth conversion, and it deserves its own deep exploration. The short version: in years when your income is relatively low, like those early retirement years before Social Security begins, you can deliberately move money from your traditional IRA to your Roth, paying income tax on it at today's lower rates rather than potentially higher rates later, and permanently shrinking the account that will eventually be subject to RMDs. For Phil and Claire, the numbers on Roth conversions are striking. Running their full scenario, optimal withdrawal sequencing plus strategic Roth conversions could mean an additional $1.8 million in portfolio value over the life of their retirement. That's not a typo. The power of reducing that tax-deferred account before the government forces you to is that dramatic. But we'll save the full Roth conversion conversation for another day. For now, just know that it belongs in your retirement planning toolkit, and that the early years of retirement, low income, manageable tax brackets, are often the ideal time to execute it. What this means for you, I want to slow down here for a moment because I think it's easy to read something like this and feel overwhelmed. The tax code is genuinely complicated. Retirement planning involves dozens of moving parts, and the stakes are high. These are the savings you've spent a lifetime building. So let me say this plainly. The goal of understanding these strategies isn't to make you feel like you have to become a tax expert. The goal is to help you ask better questions, have more informed conversations with your advisors, and recognize that the sequence of your withdrawals is every bit as important as the amount you've saved. A few principles to carry with you. Understand your gap first. Before you think about which account to tap, know what your guaranteed income covers and what it doesn't. That gap number is your target. Let the Roth grow as long as possible. The tax-free compounding inside a Roth is irreplaceable. Don't spend it early just because it feels painless. Be wary of large, unplanned tax-deferred withdrawals. Every dollar you pull from your traditional IRA or 401k is ordinary income. Pulling too much too fast can cascade into higher Social Security taxes and Medicare surcharges. Plan ahead for RMDs. If you have large traditional account balances, RMDs are coming. The earlier you start managing toward them, through withdrawal sequencing and Roth conversions, the more control you retain. Your situation is unique. I've walked through Phil and Claire's example in some detail, but they are one couple with one particular set of assets, income sources, and goals. Your numbers will be different. Your optimal strategy will be different. What doesn't change is the importance of being intentional, of making these decisions deliberately rather than by default. The tools you need. Here's something I genuinely believe. Most people are making withdrawal decisions in the dark, without real data about the long-term tax implications of their choices. They pull from whichever account seems most convenient or most intuitive, without ever running the numbers on what different strategies would actually cost them over 20 or 30 years. You deserve better than that. And the good news is, the tools to do this analysis exist and are increasingly accessible. Financial planning software, the kind advisors use, can model your specific situation across different withdrawal scenarios, show you the tax implications year by year, project the impact on your heirs, and help you identify the sequence that maximizes your portfolio's long-term value. Seeing those numbers laid out visually, watching the gap between strategies widen over time, has a way of making the abstract suddenly, urgently concrete. If you're working with a financial planner, this kind of tax-aware withdrawal analysis should be a standard part of the conversation. If it isn't, ask for it. If you're managing your own retirement, consider investing some time in planning software that lets you model these scenarios yourself. The ability to play with your own numbers, to see what happens if you delay Social Security, or do a Roth conversion, or change the order of your withdrawals, is enormously empowering. A final word: retirement is one of the most significant financial transitions you'll ever make. The paycheck stops, the accumulation phase ends, and suddenly you are responsible for generating your own income from the wealth you've built for potentially 30 years or more. The decisions you make in those first years of retirement, which accounts to tap, in what order, in what amounts, can echo through your entire financial life. They can mean the difference between running out of money too soon and having a cushion that lasts, between leaving a meaningful legacy for your family and watching your heirs pay an avoidable tax bill, between spending your later years with financial confidence and spending them with quiet, persistent worry. None of us saves and sacrifices for decades just to stumble at the finish line because of a withdrawal order we chose by accident. So take the time to understand these strategies, run your numbers, ask for help if you need it, and approach this phase of your financial life with the same intentionality and care you brought to building it. You've earned this. Now let's make sure you get every dollar of what you've worked for. The emotional side of this, because it's real. I'd be doing you a disservice if I only talked about the math, because retirement is not just a financial event, it's an emotional one. And the way we feel about our money in retirement can sometimes work against us in ways that are just as damaging as a poor tax strategy. Here's what I mean. Many retirees feel a deep, almost instinctive reluctance to spend down their principal. They've spent 30 or 40 years watching that number go up. Every statement was a small affirmation that they were doing the right thing, building security, moving toward the future they wanted. And then retirement arrives, and the task shifts completely. Now you're supposed to draw the number down. You're supposed to spend it. And for many people, that shift is psychologically brutal. What I've seen happen again and again is that this reluctance leads people to delay drawing from their accounts in ways that actually hurt them. They underspend in early retirement, the years when they're healthiest, most active, and most able to enjoy it, and then either spend too much later or leave behind a large, heavily taxed estate that their children have to navigate. Neither outcome reflects what they actually wanted. The withdrawal sequencing strategies we've talked about today are meant to serve your life, not the other way around. The point of minimizing taxes isn't just to preserve the number on a statement, it's to fund experiences, security, generosity, and peace of mind. It's to give you the confidence to spend on the things that matter without the nagging fear that you're making a mistake. Understanding where your money is coming from, knowing that you have a plan, that you're drawing from accounts in the right order, that you're not handing unnecessary money to the IRS, can be genuinely liberating. It can be the difference between a retiree who says yes to the trip to Portugal and one who stays home because they're not sure they can afford it. That clarity is worth pursuing, and it starts with exactly the kind of intentional planning we've been discussing, common mistakes to avoid. Before we wrap up, I want to flag a few withdrawal mistakes that I see come up repeatedly, not to be discouraging, but because awareness is the first step to avoiding them. Pulling from the Roth first because it feels free. This is perhaps the most common error. Tax-free withdrawals feel wonderful, and so people default to them without realizing that they're cutting short years of tax-free compounding that can never be recovered. Save the Roth for last. Ignoring the capital gains opportunity in early retirement. Those early years before Social Security kicks in and income is low are a genuinely precious window for realizing capital gains at reduced or even zero federal tax rates. Many people don't realize this opportunity exists and let it pass unused, withdrawing too much from tax-deferred accounts too soon. There's a temptation when you have a large 401k balance to view it as the obvious place to go. And eventually, yes, it will need to be drawn down. But pulling too heavily from these accounts in the early years can push you into higher brackets, increase your Social Security tax exposure, and trigger Medicare surcharges. Failing to plan for RMDs before they happen. RMDs don't arrive with a warning. They arrive when you turn 73, and they can dramatically reshape your tax situation. The time to prepare for them is in the years leading up to that age, ideally through Roth conversions that reduce the balance subject to mandatory withdrawals. Treating the withdrawal strategy as a one-time decision. Your financial situation in retirement is not static. Tax laws change, your health changes, your spending needs change, markets move. A withdrawal strategy that made perfect sense at 65 may need adjustment at 72. This is another reason why maintaining an ongoing relationship with a financial planner, rather than setting a plan and forgetting it, pays real dividends. Putting it all together. Retirement income planning is, at its heart, a puzzle. You have multiple pieces: Social Security, possibly a pension, taxable accounts, tax-deferred accounts, Roth accounts, and your job is to arrange them in the sequence that best serves your life and minimizes what you pay in taxes over the long run. The optimal sequence for most people follows a general pattern. Start with taxable accounts during the low-income early retirement years, capitalizing on favorable capital gains treatment. Then shift to tax-deferred accounts as other income sources kick in, managing your brackets deliberately, and preserve the Roth for as long as possible, allowing it to compound tax-free and serve as both a financial cushion and a legacy asset. Layer in Social Security timing, Roth conversion opportunities, and careful attention to RMDs, and you have the foundation of a genuinely sophisticated and genuinely effective retirement income plan. Is it complicated? Yes. Does it require ongoing attention and adjustment? Absolutely. Is it worth the effort? The $500,000 difference we saw in Phil and Claire's case says it better than I ever could. The numbers are real, the strategies are accessible, and the peace of mind that comes from knowing you have a plan, a real tax-aware, thoughtfully sequenced plan, is priceless. You've done the hard work of saving. Now do the smart work of spending. Your future self will thank you.